Welcome to Biz With Blad. I'm your host, Vladimir Mercedes, and today I have a very special guest with me. Bill Tessar is the president and CEO of CV3 Financial Services, one of the fastest growing private lenders in the country. With over 35 years in the mortgage industry, Bill has originated and overseen more than $40 billion in loans. He previously scaled Civic Financial Services into a powerhouse before launching CV3 Financial Services, which crossed $1 billion in funding in its very first year. Bill is also the host of the popular podcast, Unconventional with Bill Tessar. Today we're going to talk a little bit about his incredible journey, the current state of the private lending industry, where real estate investors and brokers should know and need to know right now, leadership lessons, and how artificial intelligence is changing the landscape for both real estate and the construction industry. Bill, thank you so much for being here today. I'm so honored to have you here. Thank you so much for coming from such a far place and also to be present at our event that we have tomorrow.
I'm looking forward to that. Yeah, Blad. What I need you to do is I need you to do that intro when I come home. I want my wife to hear that. It sounds way better than reality for my wife when she hears those things.
I'm going to do my best.
Please.
And in honor to you, obviously, we have, for the first time, this is not a standard that we're ready to set. We found a bottle. Don't ask me how we got it. We found a bottle of Macallan 18. And I want to toast with you.
Go.
Cheers.
God bless you.
Thank you so much for everything that you do.
Yes, thank you.
Bill, I have so many questions to ask you, but I want to start with, I read somewhere that you had an accident. You were hit by a drunk driver at 16 years old. How did that accident shape you, and that it was a catalyst for you to be in the mortgage industry? Tell us a little bit about that, how it happened, and how that catalyst got you into the mortgage industry.
Yeah, so we were coming back from a school dance. So 16, I think I was in 10th grade. And back then, seatbelts weren't a requirement. And so we had a pickup truck. The driver was driving. There was a girl next to him. And then I was in the passenger seat, and there was a girl on my lap. And we were coming off an off-ramp, and a drunk driver hit us. We were coming off at about 45 miles an hour, and they hit us close to 90. And what happened was the percussion of the hit sent my body, even with someone on my lap, through the back windshield onto the freeway. And, I split open my head. Somebody in a Ranchero, which is a two-seat car with a cabin, picked me up, put me in the back of the car, and took me to the hospital, which obviously I think at the time saved my life. I ended up recovering from that, and there was a lawsuit that prevailed. And look, Blad, I came from a very lower middle class family, so we didn't have much money at all. But the accident actually resulted in me getting paid quite a bit of money. And I ended up buying my first home when I was, 18 years old. And going through that process, just like you and I are talking with the table in front of us, the loan officer was going through what they called a good faith estimate on my very first home I was buying. And if my memory serves me, it was about $105,000 house. And I remember back then the good faith had like the small fees on the top, and I had a lot of questions. So it was like credit report. I think back then it was like $25. And so credit report, $25. I go, what is that? Oh, this is what collects all of your pay history, which, as an 18-year-old, you don't have much.
Yeah.
Then they go like processing fee, and maybe it was $125. What is that? Oh, these people collect all your paperwork and they set it up so you can get an approval. Underwriting. What is an underwriter? Like there's a lot of things. Underwriter, doc, title, escrow, all the way down, explaining every single one. And then it came to the bottom, not the top, loan origination. And it was the biggest number on the good faith estimate. And I remember it like it happened yesterday. It was like $1,000 and change, 1,050. It was 1 point. And I go, what is that? And I remember the loan originator was re-explaining all of the things for the other charges. And I said, no. That was processing. That was escrow. That's my credit. Like, what is this? And he goes, well, that's what I get paid. And I said, whoa. And I'm 18. I go, hold on a second. So it's my credit report. You got Sally, the processor that's processing my paperwork, and Ben, the underwriter who's underwriting it. And you got docs and this escrow company and this title. so you're collecting my paperwork, you're giving it to them, and you're getting paid that? And he goes, yes. And at that moment, I said, how do I do what you do? How do I become a loan officer? Because like the idea, that was 1985. So $1,000 in 1985 to meet with somebody and provide financing to me seemed like a miracle. My dad was an appliance repairman. He made like $12,000 a year. And I'm thinking like, I could easily do this. And so, shortly after I bought that home, I went and got licensed and I worked for a lending company. And I asked them how to prospect. They showed me how to prospect. And back then it was a yellow pages. There were no like trigger leads or anything like that. Days. You open it up and you start with A. You don't know if that A is a renter, if that A is a convict, or if that A is a homeowner. You just go down the list.
You have no information on what's in there.
No, you have none. And so I just went down that, and I never left home without a stack of cards. And anybody that was in my vicinity would get a card and get my elevator pitch, whatever that was at the time. And I think I was a year in. I was the number one originator in the company. It was a company called King's Financial, which was a national company. And I was making more money than my father made in a year in a month, my first year in college.
That's incredible.
Like it was and I just loved it. I couldn't believe, to this day, honestly, Blad, I can't believe that providing such a needed service to those that are looking for financing compensates originators the way that it does. And it's never changed 40 years later.
Yeah, it's very generous, and part of the reason why I do it as well. So I'm still blown away by how generous the compensation is for a valued service. You mentioned something that I was going to get right into. That was actually my next question. You come from very humble beginnings. A stay-at-home mom, your dad repair appliances. How that upbringing has that made you into the leader that you are today? What's the lesson there from coming from such a humble beginnings and being a self-made man?
We were, I was golfing with some friends the other day, and one of my friends is part of a family where his inheritance is going to be massive. Like we know that his dad's a high net worth person, and
he was born into that money.
Yes, born into the money. We were just talking about it,
Okay.
and I remember thinking just after I hit my shot, like that never factored into my thinking, my day-to-day, my planning. I always knew any dollar that was going to stay with me was going to have to be earned by me. And it just never occurred to me that that was an option. Like you look at my children now, when my time comes, like they're all going to be very, very well taken care of. Their children's children should be very well taken care of. And God bless the Lord for giving me the opportunity to be able to do that.
That's what we all want.
But I will tell you, to this day, I've had this statement that I don't talk about it much, but it was called originate scared. And every single day, to this day, I still have that in my mind after everything that I've been through and the ups and downs and all that has been accomplished, that I still have a little bit of originate scared, because you just don't know. When you come from nothing, you think nothing could be right around the corner. And I think that has been a big driver for me my entire life. And I think for some that don't have that, I think they're at a disadvantage, because you wouldn't know what that is unless you were born into it. And I've done my very, very best at trying to shape my children to have that same work ethic. But I think we'd all be foolish to think that in the back of their head, they don't know there's some backstop that when my time comes, even if it's when I'm 90 or 100, that, they're in a good place. Or even now, before I leave, if they need some assistance on something, they know that they have it. I never had that. My dad was the best dad in the world. He showed me how to work hard. He loved his job, like literally making $1,000 a month. And fixing people's ovens on Thanksgiving Day while we're all waiting to eat a turkey. He loved what he did, and he did it for like $29.95 a service call, like ridiculously low numbers.
That's for different
but he
times.
Loved it. Yeah, different times. But Blad, like the lesson for me is, no matter how much money you make, high, medium, or low, you got to love what you do. And I think if you do that, you're going to be great at whatever that title is. You could be a trash man, you could be a doctor, you could be an attorney, or you could be a loan originator. I think if you love it, you'll be great at it.
100%. And speaking of that, Bill, let's get right into the origination.
Before you do, I'm really enjoying the McAllen.
Listen,
cheers.
It's an original. Cheers, man. Again, I'm so
Cheers.
excited to have you here. I can barely contain myself. And Bill, you were in the conventional world, and then you scaled that in a massive way from what I'm reading and the research, and then you went into the private lending space. What was the biggest shock going from that industry? Well, it's the same kind of industry, but right, it's a whole different business model. What was that like? What was the biggest shocker when you made that transition into private lending?
So I started in '85. In 2016, well, if I back up a little bit, in 2007, when the financial crisis hit, I had a pretty good size origination company out of Calabasas. And when the financial crisis hit, there was a thing called a mortgage implode meter where the biggest companies in the United States were going out, the Countrywides, the RFCs, the GMAC, Norwest, all of them. And we had stockpiled some cash, we had unbelievable marketing, and we had a crazy sales team. And so what we did was we parlayed that and we acquired 51% of a national platform that had their Fannie, Freddie, Jenny. They had all their warehouse lines and all the things set that we didn't have from a license and from a geo perspective. We bought 51% of that company. And literally in the eye of the storm, we scaled. The company was called Skyline through 07, 08, 09, 10, 11, 12. And how we did it, Blad, is we went to local regional originators that were really large, that didn't have the financial wherewithal to withstand the financial crisis. And we literally were picking up these companies for FF&E, furniture, fixture, and equipment. No goodwill payments, no cash. We gave them a place to hang their hat. We scaled with originators and we picked the very best operators that we could. And we built that business from 07 to like 15, 16, from 60, 70 million a month, maybe 100 people, to 4 billion a year, doing with 650 people nationally. But what was clear to me at that time is the conventional world became commoditized, and every loan, people were arguing over, $40 on a credit report fee. And it was so, the margins were so tight. At that time you had Dodd-Frank, so the government was now deeply embedded in conventional. And I always felt like it was flying a 747, like 50 feet above the street. Like the margin
almost
of
crashing.
The margin of error was just a hiccup, and then you'd crash. And I always felt that even though we had success and we were building the business, and what had happened in 16 was we had bought a company from a mortgage company from a company called Wedgwood out in the South Bay. And we didn't do it because they had a nice company. We did it because Wedgwood was the largest independent fix and flipper in the nation. They were acquiring, beautifying, and flipping about 400 homes a month. Big operation. And so they tried their hand at mortgage, but if you're not like all in mortgage during that time, it's not a good business. You have to be all in. So they recognized that. They sold the business to us and then invested in us. And then I took an advisory role on their parent company. And what ends up happening is like 6 months. So when we did that, they started this little business purpose lending company with 5 people called Civic. And their thinking was, we're on the courthouse steps. We know distressed properties. We know that type of loan. We'll do this. And so I saw it. I watched Civic with just a few of those people, and they did a loan, and they did 5 loans. They did 5 million a month. Then they did 10. When they got to like 20 million, they had like 40 people. The CEO of the parent company and one of his partners came to me and they said, could you help us find a CEO for this business to help us scale? And so I had teed up 2 or 3 people for them to interview. It didn't.
Were you the CEO of the other company?
I was CEO of Skyline.
Yeah, okay.
Yeah.
Just wanted to get
I was president of Skyline.
Okay.
And so I teed it up. That didn't work out. And then they made a run on me. Now, if you just pause for 1 second, and I'm going to have you jump into my chair. I've been with the same gal for 35 years. I lived in the same community for 50 years. We were at that company. So the company I owned was from the mid 90s. And then that company bought Skyline. So figure that company for 20 years. I didn't move around. And so the idea of leaving a presidential position where I oversaw 650 people, most of whom I had hired. I was a high comp individual. I loved what I did. And I wasn't looking to change to join a 40-man business purpose lending shop. Like I always thought it was like just hard money.
Yeah.
Like if you don't pay, someone gets their knees broke, right? And so, look, I saw no path forward for that. And I wanted to be polite and respectful. And so finally, after months of them coming back and back and back to me, I decided to do diligence on the company, financial diligence. And I spent a 3-day weekend. I have 4 screens at my house. And I remember downloading like financials, warehouse line agreements, execution on their sales, all their stuff. And I downloaded it all to the left. And if I didn't need to know about it, it went to the right. If I had questions, it went up to the left. And if it was something of interest, it went up to the left and to the right of my screens, just how I processed the info. I went through it, and 3 days later, I said, oh my God, this company is doing like 1/17th our volume
1/17.
and making 15 times the profit.
The margins.
And so I thought they provided me false documentation. These highly credible, high net worth individuals that had a national platform thought they provided me fraudulent stuff because it can't be.
You couldn't believe it.
No, I've been in the business too long. I know it too well. And as it turns out, that business is entirely different. It's not about a credit report fee or an origination point. It's about access to capital and delivering what you say they can do, because the people who were borrowing it were beautifying properties and making a boatload of money. And the interest and fees are part of the cost of doing business. And so when I realized that was right and we got the construct correct, I ended up stepping down from my position. I left my stock in the company. I worked out a transition.
You mean you left your stock? You forfeited the stock?
I didn't forfeit it.
Okay,
I just left it.
Okay, just left it.
I didn't forfeit it.
I wanted to make sure I get my words right.
But I owned interest in technology companies that had owned it as well. And I wasn't competing with them. So I felt okay. I didn't feel like I was abandoning my 650 to go to a competitor and meet them head to head in the street. I knew it was a different line of work. But look, I had to have a come to Jesus meeting with my wife, because it was going to require us to kind of get up and go to the South Bay and do this. My children were older at the time. And, you know, after a lot of discussion and prayer, we said, we're going to do this. And so when I did it, I ended up moving with my head of operations, who had been with me for 10 years at the time, still with me to this day. And we joined Civic Financial in February of 2017, doing $20 million a month, 40 people. So what we did was we spent the first 90 days just watching and taking notes. That's all we did. I watched what time Blad came in, what Blad did throughout the day, how we prospect, how our platforms work, what was our marketing campaign, social media, how people priced loans, how we were compensating. And, you know, I got a wealth of information over those 90 days and then went to work, like really went to work with change. And it was immediate. Like, we were bringing people into the industry, the BPL industry, from the conventional shop, people that I knew, liked, and trusted. And I think the first year in 17, as we put new platforms, new pricing strategy, new capital partnerships, new a social media push, the entire thing you need to do for a mortgage company, we implemented. We did $650 million our first year, which was, you know, about $50 million a month, which was significant at the time. 18, we did just under $1 billion, and then 19, we entered into a deal to be acquired by Credit Suisse. We signed a definitive agreement, and you know, we were a national player at that time. And I'm going fast here, but in 19, when we signed it, it took us into the altar of 20. And as we were signing docs, this thing called COVID hit.
Yes.
Which obviously was, at the moment, it felt a lot like the financial crisis, because no one knew what was going to happen with real estate.
The uncertainty was, it was certain uncertainty.
It was massive. Like, it was massive, Blad. And it was a scary time for me because I had a very young company. And young meaning like the average age was close to 30 years old, which, when you think about kids going to high school and college, coming out, there's not a lot of tenure there. And I just wasn't sure how they were going to react to the push of moving everyone to home. And we could talk a little bit more about that, but that was probably the first big hiccup in the business purpose lending space for me that ended up and turned out to be like a massive blessing in disguise.
Yeah.
And I don't know how you guys did it, but like, we required 95% of our people to work from home.
We were already working from home with a virtual office. But the change, when that uncertainty created a lot of opportunities for us, because we were known for working a lot with SBA loans. Everything else shut down except the SBA for business funding. And
SBA kind of boomed, right? They had the EIDL and the PPP.
The EIDLs and the PPP. And what happened with us was funny, because all of the brokers that were doing more MCAs and doing some, more traditional products, they turned to us. You guys were already doing SBA loans, so why don't we give you all these clients? And it turned out to be we were doing like therapy sessions with people, just letting them know. Look, because there was a point where people didn't even know if they were going to get that money.
Right.
And their business were completely shut down.
Yeah.
So I always said to people, and I trained the few consultants that I had, let people know that if the government doesn't come through with this money, that we're all screwed. It's like, might as well turn to your gun. So the government will make good on these. They're going to fund these loans. And they did.
Yeah.
And I'm telling you, Bill, it saved so many businesses. It saved hundreds of businesses. I saw it with my own eyes. Some of them did better, some of them did worse, some of them didn't survive for long.
Some of them bought a bunch of Louis Vuitton, didn't do anything for the business.
Yeah. Well, I don't know what they did with the money. I rather don't know. But COVID was a very interesting time, and I'm glad that you shared some of the positive impacts that it had, because it definitely had a positive impact on my business. I want to go right next to my next question, which is, you mentioned some of the people that you had working with you. When you went I'm going to move from Civic to CV3. When you started CV3 Financial, I understand that you started it with a large group of people, and you're known for being a leader that has a loyal following. What does it take for you to go and start a new company, have a whole bunch of people following you? And I hope that this is a good question, because that's really what I want to gain insight is into, who you are as a leader and why it is that people are so loyal to you.
Thank you.
So that's really the question.
So take a step back. If you finish the Civic story, the good thing about COVID was people proved to me that they could work from home in mass scale. And I think what I learned, probably more than anything else out of COVID, is that when you allow people to eliminate the commutes back and forth, to spend time with their pets, to spend time with their little children, to spend time with their older mom or dad that might need attention, they figure out a way to get the job done. And what I realized is, like, being shoulder to shoulder in massive offices so you could keep an eye on people. People will govern themselves if you give them the flexibility and freedom to do some of the other things that are important in their life. And we roared through 20 so much so that we ended up getting acquired by PacWest, a publicly traded bank.
Yep.
We closed that in February of 21, still like in the midst of COVID.
Yep.
We do $1.7 billion in 10 months of 21. We do $3 billion in 22, number one in the nation at the time. And what happens is I was contacted by one of the C-suite guys, and they said, look, this is a $43 billion parent company bank, massive bank. And he said, the bank has balance sheet problems. And I'm going like, what are you talking about? But what had happened was they bought $8 billion of treasuries at the 170 coupon. That moved to 460. So they lost like 60% of that value. And big companies were pulling the deposits from their bank, $5 billion a quarter.
That's
so
like almost like a run.
it was.
Okay.
I mean, remember First Republic and the Silicon Valley banks that had failed. So this was all the big thing, the regional bank failure, and our parent company fell in that. So what they said was, we need to spin Civic out. We need to spin them out. And can you do it? And so I created two big partnerships in Wall Street. We entered into an agreement. We signed an agreement for us to spin Civic out. We went into January of 23, early January, and I get a phone call on a Saturday from my attorney saying, and this deal, Blad, that we put together was unbelievable because the bank just wanted to flash a price of what they paid, and the company was worth 4 times that. They gave us warehouse lines, forward loan flow agreements. They gave us the asset management strip on $3 billion of loans, the servicing strip, and they gave us terms on the cash. So I raised the money fast, 2 weeks effectively of commitments. We enter into this agreement, and on that Saturday, they said, hey, they're taking all of these ancillary things off the table. They want all cash. He goes, you know about that? I go, I have no idea. And what I didn't know at the time that I learned months later was that the FDIC was in the bank. They were going to take over the bank, and they basically said
they were getting ready for the takeover.
And they said, you can't commit to this stuff. We're not letting you. They didn't say that to me where we could have got back in the room and figured it out. They just said all the benefit of the deal is off, and they effectively wanted me to pay 9 figures for the people that I had brought in. And there was at the time, there was 500 of them. And so I said, that's not going to happen. I'm not going to do that. We went back and forth for 5 days. On the 5th day, pencils down, they came in and they termed me and they termed our general counsel. So they set up the management buyout. They gave us the outline to do it. We followed the outline. We delivered. FDIC says they can't, and then they term us. So when they termed us, that was January 18th, 2023. Won't forget that day. First time in my life I'd ever been fired from anything. They began the wind down of Civic. They halted all fundings. We had 1,700 loans in the pipeline. They tried to get out of funding commitments with the borrowers. They started decoupling vendor relationships and working out of leases. They termed 250 of our employees like a month later as part of the RIF. And look, it was a tremendously emotional time because the people that worked at Civic were unbelievable employees that had done remarkable things in the space. They did nothing wrong. We fell subject to a bank that had mismanaged the balance sheet and it fell into the regional banking crisis. And so effectively, the day after I was termed, I said, I am going to stand up a new company. And CV3 by definition is Core Group version 3.
I always wanted to ask you where the name came from, and I didn't have a chance to ask you.
Yeah, so it's Core Group, our Core Group, yeah. Right? Underneath Wedgwood, yeah. Underneath PacWest, and then this. So it's Core Group version 3. And so if you think about it, I basically had at that time, I had 3 or 4 jobs. The first job I had a legal claim against the bank because they termed me without cause. So that's a lot of energy. The second is I was negotiating outside of that for all of my people to get severance checks. So I was just doing that and advising them on how they can get paid while this wind down occurred. And the third most important thing is I had to raise capital for this next version and put together a vision that people would believe in. And the truth is, Blad, I didn't really know who was going to follow me or not. You spend a lifetime investing in people without any expectation of return, ever. And as it turned out, it ended up being unbelievable because as you referenced, on September 1, 2023, we stood up CV3, and I did it with 155 people day one. And how I did the 155 is we had our executive team of 12. We took 11. One of them was kind of a transplant from the old company, and it was probably a good time for separation. So we took 11 of them. We took the top 37 originators. We had 80. We took the top 37 that did 92% of the 3 billion. And then we had all of my executive team hand pick out of the 500 the best and brightest of the operations and shared service. And that equaled 155. It wasn't like we got together in my kitchen and go, okay, here's the number. Let's hire to it. It just turned out to be that. And our day one, we opened the doors. Everyone came down to our corporate office and we had a kickoff, but we had 155 people, 155 benefits, 155 payrolls, and we didn't have a loan in the pipeline.
Bill, isn't that nerve wracking? I'm trying to wrap my head around what it's like to have that many people and commit to something completely new, basically a startup. I mean, where do you get the balls to what gives you the confidence to to lead that many people into basically what could be a bloodbath? I mean, how do you get the assurance? Is it the commitment from your partners? I want to dig into that if you can answer that question. I'm imagining it's like, that's unbelievable that you have that many people already committed, that you work with, and you led them out of this company or whatever was happening there into this new venture. And do you have everything figured out? Do you have the capital to pay them? What gives you the confidence to have that many people committed into this new venture?
So on the left side of my brain, I knew that I was going to pay 9 figures for this company that we built. And now I could take 155 of the best and brightest for 0. So whatever cash I would burn for the next year or 2 years,
it's going to go to
would be what I paid for the business.
Okay.
And so I always thought, like when we did our modeling, that it would take us a couple years to cross break even. But like the very first month, you're going to lose 2 million. You got salaries, or 2.5 million. Then maybe you close some loans, 2.3 million, then 2.1, then 2, then 1.5. And so the goal, the belief was we had the right people to scale the business quick enough. So wherever we got to break even, it would be a deep discount of what we put together. And so that was the thinking. That's what I represented to the capital partners. And so everyone got that. The question was, can we do it? And so the first month, we were just plugging shit into the computers and putting up pictures and getting situated. October was our first origination month. We closed over 50 million. And in November, we closed over 60. And in December, it was like 75. So we were cooking. But we were literally building the plane in the air while we were flying.
I like that.
I
always use that because that's the way I feel like that a lot of the time. So that inspires me.
Blad, it's the truth. It's the truth because we didn't inherit anything from Oldco. We had to build it all from scratch. Now, when most of my executive team had 15 to 35 years of experience. So recreating platforms, marketing, pricing, capital partners, like all my relationships were intact. And so you start with a warehouse line, then you get 2, then you build to 3. You start with 1 capital outlet, then you get 2, then you have 6. You start with maybe 1 or 2 products in 10 states, you grow to 12. And it literally happened that way. In the first year, 24 was our first official year, we did $1.1 billion.
Yeah, I was going to get into that. Within your first year at CV3, you did over $1 billion. I mean, it's all out there. And I think you've answered how all of that happened. But I just want to hear you say it again. What does it take to get a company within your first year? And you do over $1 billion in funding with CV3 Financial. And I know it has to do something with the people that you hire and your leadership. But what went right for that to have such a great year in origination?
There's been hundreds of books written about people's why. Like everyone has to have a why. Why? Like, why do you do what you do? Oh, I do what I do because I like to inspire other people to build their net worth. I do what I do because I like beautifying homes. I do what I do because I like changing people's lives. Whatever it is, what I will tell you is 155 people that we hired felt like something was taken from them. And their why was building that back. We always talk about at our office, we talk about getting the belt back. And at the time Oldco was shut down, we were number one in the space. Volume, profitability, quality loans. Like we were the cat's meow. We were the heavyweight champs of that space. And so everyone wanted to get the belt back. And so if you talk to different employees today, they'll tell you, I mention it all the time. Like we're doing this, this, and this. We're here now. We're going to get the belt back. We're going to get the belt back. And look, at the belt, it takes a lot to get it back. There's been a lot of change in the industry. And so we recognize
you might be fighting a different battle now.
Slightly different battle. But I do think that everyone woke up with kind of a common theme of what, and we all knew that you got to do quality loans that are going to perform the way that you represent. You got to do quantity, a whole bunch of them, and you got to do it consistently month after month. And if you do that, the capital will come. And that's exactly what has happened. And so $1 billion is cool for marketing. It's cool to post it on social media. We get $1 billion coins and people feel good.
Sounds great.
but the fact is, Blad, like that was never our goal. We're just telling the world we've taken the first step. We do our second. I think next week we cross 4 billion, and that's 4 billion in 2.5 years. Like do you know that if you think it took Civic started in 14 and I joined in 17, we didn't hit $1 billion until 19. So from 14 to 19, 5 years, it took us to hit our first billion.
Yeah.
We did $1.7 billion in 25.
In your first year.
Well, $1.1 billion in the first year, $1.7 billion the second year. That's the second biggest year we had in the history of the other company. So, like, I
think you got the belt back.
Not yet. We don't. I will tell you. I'll have the Conor McGregor swagger if we ever get there. We're not there yet. It's a little bit of ways, but we do have a vision on it for sure.
Bill, and you know, since we're talking about CV3, and I happen to broker some loans for you guys, and I'm totally
not some, over 100. Just to be clear,
I'll get my belt someday.
Yeah,
I'm really obviously blown away by how you treat everyone and everything. What makes CV3 different? Why should brokers and investors go to CV3? I know the answer. I just want to hear from you, though. I know my why, but
yeah, I think like we are invested in the well-being of that business enterprise beyond delivering a loan at a rate. Like anybody can do that. I think having sticky capital where for a fact that we will show up at the closing table as promised without retrading you, even though rates may move in the middle of the transaction. Like I think that's important. But more important, we are constantly investing and finding ways to help people with marketing, to help people with digital branding, to help people with tech. Like today we have 260 employees. All 260 employees' responsibility is not to just the people within CV3. It's to our network of real estate investors and brokers throughout our organization. And so we take all of the resources we have and make them available to you, Blad, or anyone that wants to access them. And I think like if it's me or Johnny Financial, and Johnny Financial is just trying to compete on rate and fees, and I am investing in all those other aspects of your business and trying to provide insight, direction, assistance. I think that the other side of that coin is people respond well to that. It's actually why I actually believe that the 155 people showed up. I've invested my entire career in people, and they do the same thing for companies like yours, or investors that are individual. Like we don't discriminate against that. It's like if you're in our camp, then we're chips all in on you. And I think that is a material difference. And you have to differentiate yourself in this marketplace somehow. So the way we do it is we're just any resources we have that help Blad be a better version of Blad, you have access to.
And I've seen that firsthand with everything, every aspect of your business, from the communication of the rep to obviously supporting and rewarding us for achieving different goals. It's really an unbelievable experience, which is why I so openly endorse and want to continue to be a champion for CV3, because it's like when you eat at a good restaurant, you just want everybody to have that food for whatever reason. So I think
Thank
you
you
guys,
for that.
and you know that that's exactly how I feel. Do you think being a real estate investor, because you're an active real estate investor yourself, how has that shaped the way you run CV3 Financial?
Well, first of all, I know the fears and pitfalls that are in front. Like some of my top originators will tell you, if they bring me to a big meeting and I see flaws in that investor's plan, even to the extent which could cost that rep millions of dollars in potential financing, I am going to say it. If I think you're getting involved in a transaction that you might want to double think about, I'm going to tell you, and I'm going to tell you why. We had a very big investor who was doing real things. He was flipping properties from the $800 to $2.5 million range and finding great success. And he wanted to take down this really big nationally known property that was going to cost him $21 million to buy. And
Just the acquisition.
Just the acquisition. The property had previously traded for $73 million from a New York investor. Then it was sold to a singer for like $57 million. That singer tore it, kind of stripped it down. It was in Malibu, and he thought he could put $7 million back in and hit a home run. I sat across, so the originators in the office, I sat across the table like you and I are, and I told the guy, do not do this transaction. It's going to get you away from what has been core in your business and what you've been successful on. The risk reward isn't worth it. He looked me in the face and said, this is going to put us on the map. So I was actually personally able to arrange the financing. And the truth is, he ended up going down. That property ended up going NOD. He didn't do what he said he was going to do. The private family that I brought into this is going through the process of taking that back. They're happy to have it. I don't want to do a loan for the origination fee or whatever servicing income there is. I want to make sure that the person on the other side of the table is investing in something that they could be successful in. So I think that like I've been doing it for 4 decades. And I've seen what success looks like, and I've seen what failure looks like. And I'm going to share that, no matter what.
That really confirms what I already know. I think that you being an active real estate investor brings a lot of insight into the people that you serve, which at the end of the day is, the investors that are using your product. So I just wanted to know, how that affects the way you run CV3 Financial, and thanks for sharing that. That is a remarkable story, because you foresaw that. You had a chance to tell people, which is one of the funniest things that I realized. A friend of mine calls, and I definitely not here to call your client in case he's hearing this. Ask hole, which is somebody who asks and pays for advice, and you give it to them, they still do the opposite. Yeah. I've been on those situations countless times, and that really is how it feels, because if you have somebody that already knows how and gives you unbiased, because you want to do the loan, right? At the end of the day, you almost benefit from doing the loan, and you give the person the advice that the risk to reward is just not there. You should just stick to that. Is such good advice that is like, it's objective, because you're like almost like removing yourself from a very large transaction just to the benefit of that investor, and they still don't take it. So I've seen that so many times.
And it wasn't advice. It was as enthusiastic as I could be about something that has upside. I could be just as enthusiastic about potential pitfalls if I see them. And I understand how one's judgment can get clouded over the hope of gain. But hope is,
we smoke the hopium.
Yeah,
I smoked it plenty of times, man.
One guy told me a long time ago, and I haven't contextualized this totally, but he just said, hope is a worthless emotion. Like, you deal with facts, don't deal with hope. Meaning, do the math, have like contingency plans, make sure that whatever it is you think is going to happen, discounted, you're still okay. If you just do an entire plan on hope, 95 times out of 100, you're going to fail.
Okay. I mean, sometimes it works out, but it's just the
The five times.
The
The five times out of 100. Hope alone. Hope alone, not good. Hope with a real plan and contingency, okay.
The only thing I go by is hope is not a strategy.
I like that. I like that.
That's how I narrow it down. With all the mistakes that I made, smoking opium as well.
Yes, I like it.
Bill, what do you see the industry going as a whole for fix and flip, DSCR loans, and the core products that are new construction? What should investors know and brokers know going forward? Because you have a lot of insight into the industry. I mean, you're pretty much all the sides of it. You're vertically integrated in a lot of things. You're doing massive deals across the country and serving many real estate investors. If anybody's well informed as you, where do you see the industry going as a whole, especially on those core products?
So look, I'll deal with facts. Facts are, I think it's 54% of all the housing in the United States was built before 1980. So you're talking about 50-year-old real estate. Yeah. So you got a tremendous amount of dinged up real estate that needs attention, and how that works its way into the market. There's a myriad of different ways, but just know that more than half of all the real estate in the U.S. is dinged up. We're 7.5 million homes underwater in terms of supply and demand, meaning people that need housing and housing that is available. It doesn't matter what it is, Blad. It does not matter. Geopolitical craziness, rates going up, wars or no wars, floods or fires, all the stuff I've dealt with for 40 years. Does not matter. It all comes down to supply and demand. So if I, in my seat, know that half of the real estate is dinged up and pre-1980, and I know that you're 7.5 million homes underwater from a supply and demand perspective, I see nothing but opportunity on that side of the page. And on the other side of the page, what has happened for the BPL space, as you see more securitizations happen, it's becoming institutionalized, and you're seeing a plethora of capital coming into our space that wants to be part of what you and I do every day. And I'm telling you, in all my years of the business, I have never seen a situation where there is more capital than there is opportunity, which is nirvana.
This is the third time I heard you say this, Bill. I've been listening. This is the third time, and I'm really stuck on that particular part when there is so much capital available for these opportunities.
There is.
It's that only good things can come out of it.
And listen, that capital is going to attach itself to the operators that are thinking like they're in the seat of the capital providers, meaning they're not cutting corners on the loans they're originating. Quality loans matter. People paying as agreed matters. It matters. It matters throughout the industry, not just that particular loan. So how you govern your business, how we govern our business matters. It attracts capital. And then it goes back to the two things I said earlier. How much of this can you do? Can you do 150 or 200 million a month? Yes. Could you do that month after month after month so we could build a model around it? Yes. And if you can do that, quality, they perform, quantity, you do a whole bunch of it, consistency month after month, you'll get people knocking down your doors. Most of my time right now is spent figuring out our capital partners for the end home of the loan. That's most of my time. I just came back from New York. I was there 6 days. I had 5 days, and I had 14 meetings, and 12 of them were related to that. And you got a whole bunch of new insurance capital. There was a change in the NAIC on how they treat these types of loans on their balance sheet. These insurance companies are getting their loans. They're not securitizing them. They're putting them on their balance sheet, and it's opened up a huge spigot of new capital, aside from all the other people that want to be in the space, that is working their way in. And you're talking about hundreds of billions of dollars available when you look at, the broad canvas of new people coming in. So like if it's you and me and we own a big insurance company and we're investing people's annuities into this real estate, we want to be with the very best providers of the paper. It makes sense.
Absolutely.
I mean, it's actually very simple. A very complicated process is very simple when you understand all anybody wants is for everyone to do what they say they're going to do. If everyone does what they say they're going to do, life is, Sundays, cherries, and flowers. Like, it's beautiful.
Now that we're entering that territory, what makes things go wrong in that space? I just want to throw a little bit of salt into what appears to be a really good dynamic and a good equation. Where can things go wrong in this space? What makes it? What do you stay away from? I know we've never had this conversation. What makes a loan too risky?
So look, fraud is a real thing in our space. It is real. I think in our process, we have 18 or 19 different validators that happen behind the scenes. You have stuff like Blad and Finicity that verify actual bank statements. Bank statements is the number one form of fraud in our space. People cut and paste to this day. I thought
especially with AI and now that is, you can literally probably, I haven't tried that, obviously. I stay away from that.
Don't.
No, I have, but I can, you can do so many, you can falsify so many different things in this day and age. I'm glad that we're having this conversation about those challenges, because this is the first time I'm having this conversation.
What I would say to everyone listening is, do not think, I don't care if you have Claude, you have ChatGPT, or you have Elon Musk at your desk through Blad and Finicity, we can determine whether or not those documents came from the bank. And that's necessary.
That's great.
Because, so I think that's a big problem. The other thing is pushed values. Like, this goes back to the exuberance or over enthusiasm of a property. And what I have seen is, if you and I buy a property, we buy a property for $200,000, and we put $50,000 into it, and we get a value for $400,000, and we do an 80 cash out for $320,000. We not only have no skin in the game, but we've taken all the chips off the table and some. And so when there's a hiccup on that loan of any sorts, people will pull the ripcord plan and get on to their next transaction, because in our space, there's no credit reporting. So like, the mortgages don't show up on your Experian or your TransUnion or your Equifax. So people don't have a problem, escaping a loan and then taking the LLC down and restarting. Now, what I'm telling you is, there is more of a national movement to track that stuff. And there are companies that can track someone's social, EIN, LLCs, and kind of start cross-referencing. But that has been an issue too. So we, like, from our seat, I always like to see that someone has skin in the game. I don't mind them taking chips off the table, putting cash in their pocket, recycling it into another deal. But you buy cheap, you put a little something in, you get an inflated appraisal, you take max cash out, and you abandon. Then who ends up with that loan is that insurance company with the annuity. And if they have enough of those that they lose money on, then they take their money elsewhere out of our space, which ultimately shows up in a deficiency of capital providers in our space. And 3 years from now, we're having an entirely different conversation. So it matters.
That's amazing. No, and it's great to get insight into the fact that having skin in the game at all times for the loan makes the loan a lot less risky.
I think it does. Like, think about this, Blad. And before I make that point, maybe you could give me a little juice.
Absolutely.
Give me a little juice.
Absolutely.
But think about this.
We only have one drink on your podcast.
Yes. I drove the red eye, or flew the red eye yesterday. So
Bill,
this
I'm
is
glad
helpful.
you're enjoying it.
I appreciate you.
No,
thank you
so much for being here again.
If you buy a property for $500,000 and you put $300,000 down, and you beautified it for $50,000 and you ran into trouble, I know for a fact you have 300,000 reasons why you're going to figure out a solution. You will, even if it means you losing 30,000 of those reasons, and you take as much cash out of that deal through a fast sale to get onto your next deal. When you have no money into that, you just aren't as motivated to come up with a solution. So that's just fact. That's not feeling. That's not an opinion. You know it. I know it.
Yeah.
Like, you're not going to abandon hard equity in a deal when you have options.
Yeah, you're invested.
You are.
Yeah.
And you're invested in finding a solution. Cheers.
Yeah, absolutely. Cheers to you, Bill. Bill, and and thanks so much again for just sharing so much knowledge. I want to talk a little bit. I felt like we started last time I talked to you at Unconventional with Bill Tessar. Thanks for having me over there. We started talking a little bit about AI, and obviously we can't get away from it. And I said, you know what, I'm going to leave some of that when hopefully I have Bill over at my podcast. What are the benefits? How do you see AI affecting our industry and the real estate industry and your industry? And more importantly, do you have a concern for us losing like that human touch somewhere along the line of the whole process? Because obviously it's a fantastic tool, right? It has so many benefits. But I want to hear your insight about artificial intelligence. I really enjoy artificial. I've enjoyed tech for a long, long, long time. But I have mixed feelings. I have a little bit of excitement, and there is a little bit of fear also as to where it's going to go. How do you feel about it? Give us the whole thing, the whole shebang that you can.
Yeah. So I told you I started in 85. In 85, if you wanted information, you went to the encyclopedia. You got
or the yellow pages.
Or the yellow pages if you're prospecting. When the internet happened in the early 90s, I remember going, oh my God, the access to information at your fingertips was mind-blowing. And I remember back then, they had all these internet companies coming about. There was a bunch of them. And it was going to blow out all originators. You don't need I don't need Blad and Bill. I'm going to go online. I'm going to upload my stuff. I'm going to get my quote. And I'm going to get my loan. No Blad, no Bill.
No more brokers.
No problem. No problem. And I remember that was a really, really, really big thing. And it didn't happen that way. Sure, there are people that don't like the human touch and are just shopping on the computer to try to find the very best rate without consultation. Okay? And there will always be those people. But that was that. I will tell you that I think AI in our space is bigger than the internet. And I'm going to tell you why. Not because it's going to dislocate people. What it's going to do is it's going to allow good quality individuals to do a better quality job in more abundance with a higher degree of likelihood of success in that analysis than ever before. And I can give you little, like dumb little examples, little simple ones, like our entity review. Entity review, they'd review all they'd look, they'd read, they'd call out. You can run that through a built-in AI system with certain call outs, and then that person can focus on the call outs and be able to get through 5 or 6 of those entity reviews in a day as opposed to 1 or 2. So they never lose their job because you still need you need a validator, and there's cross-checking in this example, but that person can do more. So that would be one. We are knee deep in it. Like my executive team, 25% of their KPI, they're required to show me every quarter what they've done with AI that has made us faster, more efficient, or more cost effective. Like that's 25% of their KPI comp. They don't do it, they don't get paid. This is not like I'm not mean. This is just about us moving the ball down the field. I have watched some of our originators, how they prospect and set up their call sheets. They instruct like a Claude of all the things they're looking. They'll feed 1,000 bits of information for potential prospects, and it'll organize it with the people that have equity in certain geos that have done more than 5 deals, and they'll focus on those. So like from prospecting to document reading to, we have robotics right now. So that happen in the background when your file comes in, instead of a human looking at your file, naming your file, pulling docs out and moving them over for review, setting it up, all those functions, it does all of it. And so when the processors come in, they're looking at 7 steps ahead so they can do more of that. So it's not about the elimination of jobs. I think it's about really the scaling of those jobs and the likelihood of success of those jobs. And it's throughout the entire organization. The simple things is the writing, the marketing, all that stuff. You know, you sound like an expert in everything you do and say. But I think the robotic part of it, Artificial underwriting has been going on in our space for
it's been
30
around
years.
for a long time.
I think it's going to happen with valuations where it'll have certain call outs. It already does it with bank statements. Like there's so much that is going on right now, Blad, with AI in our space, compartmentalized, that it excites me of what that will look like a year from now. Here's what I think. I think we can do the volume. If we're going to do 2 billion this year, okay? And we have 250 people. I think that 250 people might be able to do 2.5 or 3 billion. Maybe you have a few extra folks. 2.5 to 3 billion more efficiently, not grinding overtime, working till 8 o'clock at night. So, maybe we're not hiring as much as we would have done. So maybe that's the part you're talking about, but we're certainly not looking to displace jobs. And thus far, that has not happened with our company. But we have, like, if I think about, like, at Oldco, when we did $1.7 billion, we were north of 400 people. We have 250 people.
You can do a lot more with
you
less
can.
people. No, so you can do a lot more with less people now.
Yes, you can,
That's the
for
benefit
sure.
of AI.
For sure.
Yeah, you can.
So I see that for sure. And I'm telling you, like, when we sell a pool of loans, there's a thing called a mortgage loan purchase agreement, an MLPA. It's 120 pages long. That document to review could cost you $100,000 of back and forth with attorneys. Now we could go through that document and we could present them with the 6 or 7 points of interest and let them focus on that. And maybe that representation cost us $25,000.
That is a huge.
It's unbelievable.
That is a huge reduction. Yeah, and I see that as the impact of AI. Bill, I know we've been at it for a little while and we want to start kind of winding it down, but I'm not going to let you off the hook not that quickly, especially after sharing
refill.
another one. Cheers again,
Cheers,
man. I think we're
for
toasting
sure.
a lot. Bill, walk us through the process of how these business purpose lending works. The whole behind the curtains. A lot of investors and a lot of people, I find myself explaining to them, these loans get sold in the open market. That's how the lender has liquidity to be able to keep on lending. And it's all, walk us through that whole, from a very high level. And since you're so good at, recounting stories and simplifying complex ideas, walk us through for somebody that's watching that maybe doesn't know the whole process of a DSCR loan and how they get sold in the market and all of that.
I think one of the things I've always believed is that you got to get as close to where the loan will live as you can. And so part of my job to you to be able to deliver sticky capital and predictable pricing and sharper as you get closer is what you should want you, me, where it ends. Let me tell you what happens today. What happens today is somebody in the street comes to you and you have a built-in margin. And you go to a company smaller than ours, as an example, and they fund that loan for you. And then they have a margin. And they take that loan and they sell it. Maybe they can't sell it to the end person. So they sell it to an aggregator who buys from a bunch of $5 to $10 million a month originate bankers. And they get a fee. And then they send it to like maybe a REIT or a hedge fund or somebody else in Wall Street that's a larger aggregator that's going to do a securitization. They're going to make money. Then the bond people that are investing in that securitization are going to make money. So I've always believed, how do you get to the end? And so I'll answer your question now. For us, how we are set up from a capital perspective is when you bring me $1 million loan, I have a senior warehouse facility, and that senior facility will lend 80 to 85% of the value. So let's just say 80 to keep it simple. That 80 is 800 grand. Whereas the other 200 grand, that other 200 grand comes from us. It could come in two forms. It could come in equity, meaning I'm just wiring the 200,000. It could come in a mezz piece. There are mezz lenders that will go in that second slug behind the senior.
Is that considered a second position?
It is. Okay. But so they put it in to our funding source. We fund that $1 million. You know that we owe. Maybe they do 95. So it'd be 5% our equity, 15% the mezz, 80% the senior. We then take that million and we take 99 more million and we put a pool together, and then we will sell that to whoever the end buyer is. Like what I would tell you is if you get directly into like insurance capital or someone that's going to put it on their balance sheet, they will then buy the loan from us as a whole. That premium or that spread is how our company makes money. Sometimes those loans are unsellable. We missed a FICO. We missed a value. They didn't like something and they kick it back. And if they kick it back to me, and it happens every month, it'll go on our balance sheet. We own that loan. So we will have our equity. We'll have a mezz piece that we got to pay. We have the senior piece we have to pay. And hopefully, if we've done the math right, that the rates we're paying on the first and second is still lower than whatever the coupon is. And we're earning spread. But we're not like, it's a awesome model, but there's not enough capital. Like we would need to be capitalized in the billions if that's all we wanted to do. And there was like just kind of a carryover to that question. When I was raising capital for CV3, I went to one company in Wall Street. I was up and down every building, delivering my pitch from all the biggies.
You were soliciting capital there at that
when
time.
we were before we stood up CV3, and basically what I had was I had a 32-page deck and a story, and they either believed in the story and wanted to backstop that, or they didn't. And there was many that didn't. Like you got to go through 10 no's.
Bill, I want to come back to that. I want to come back to what that was, but I don't want to take you off your point. So
yeah. So one company, huge company, huge. The guy said to me. He was pretty enthusiastic. He said, if money wasn't an object and I'd write a check as large as you needed, how much would that check be and what would you use it for? And he caught me off guard.
I was going to say, were you ready for that question?
I wasn't.
But I know you can think on your feet.
I could. And so I said, okay. So I thought out about our model, what we would do for the next 2 to 3 years. And I thought 50% would be RTL. 50% would be DSCR. And then I started doing the math. And then I figured out that, and I said, I got the answer. He goes, what is it? I go, it's 400 million. It's 400 million. I go, 400 million. He goes, okay, why? I said, well, I would never sell one of my RTLs or ground up. I'd keep them all. I'd sell the DSCR because you get paid a premium. The DSCR would pay for
It's also longer term. The DSCR is also longer term. That's
for the buyers.
Yeah,
but they pay a premium to us. So like your loan might be worth a 102. So we deliver a loan to you, you sell it to us, we put 100 million together, they might pay us 102 for that. That 2 on 100 million, 2 million is paying our overhead and everything else. But on an RTL, they don't do that. What you do is you earn a spread over the term of the loan. So you're earning a little bit every month. But if you do that month after month after month, year after year, you build up a big MSR, in the billions, and then that spits out millions of dollars every month. So it's good. It's like an insurance policy. But I said, here's what I would do. I would never sell an RTL loan, never sell a ground up. I'd keep everything because the spread is the best in that model. And when good people do bad things and they don't pay, our asset management and servicing has been doing this for 20 years. We know how to get the asset back. I'd rather us do it than have somebody else's company do it.
You'd rather deal
so
with
I figured
that
it all
pass
out.
It on to your
and I said, that's what I would do. And that would be the best economic model. Now, somebody writing a check for 400, they're going to want all or a lion's share of the company. And I wasn't willing to do something like that. But it was a really good exercise. And today, if a little fairy came down and waved the wand and said, what would you do and how would you do it? I would do that. I would keep every single loan on my balance sheet that I originate because I believe in it. I believe in the broker. I believe in the investor. I believe in the asset. I believe in everything about the loan, and I'd sell all the DSCR. That's what I would do. That would be my model.
And I said I was good. Thank you so much, Bill. For it. I wasn't ready to go into that direction, but I'm glad we're there. What was that like when you were soliciting capital and you were basically, trying to raise money to start CV3, and how much objection did you encounter before, some of those doors opened up? What was that? I want you to walk us through that because I think that's a very unusual and unconventional insight into, some of the stuff that you had to do in order to start CV3.
So the first thing was I knew that whatever I raised, we were going to retain a certain amount of equity in the company. And I have spread out part of that equity with stakeholders in the organization, so everyone feels a part of it. Not every single person, but many, a lot, like probably 50, 75 people in our company have some form of equity in our company. So that was always important to me. And I was putting up money, and I was putting up, on a side note, I had a lot of unbelievable offers in a short period of time. I was trying to raise capital to scale other things, which I had zero interest in doing. I had one kind of focal point. So that is kind of an inhibitor, because I'm thinking like we have to retain a certain part. But I believe so much in what we did in our story that for anyone not to tackle me to give me money would be a surprise. And the truth is, it just doesn't work that way. And I think, as I think back, my opinion is this. When you go up one of those Wall Street elevators to floor 65, and you sit in a big conference room and you deliver your pitch, people are looking for the problems. They're not listening to the opportunities. And the truth is, we're just coming out of a bank that has failed. So no matter what, regardless of us having nothing to do with it, you know that in the back of their head, they're going, was Blad the reason? I didn't think that at the time, but looking back, maybe that is. And then they go, maybe some of them were like, maybe it was the bank is why they were so successful. They didn't know so much about the success pre-bank. And so I think there's probably a little bit of that. And then some people, it's risky. Like you called it a startup. I presented it like a restart. It's a restart.
Restart up?
It's a restart. But I will tell you this, Blad, every single meeting I had that didn't result in a partnership of some sort just gave me more fire. Like now, like part of the immature 7th grader in me is like, when I see these folks, it's like kind of a little nod, like you kind of screwed that one up a little bit, because now all those same people are trying to figure out ways to get interconnected to us. So it drove me. It's not fun. They don't say no. What they do is the second meeting or the third meeting or the fourth meeting starts not happening. So you figure it out that way. No one ever says...
You eventually get there.
Or I had an investment banking buddy, and they would just say, it's not a good fit for us at this time. When you get it up to XYZ, please give us a call. And so it took me... I really got hot and heavy about 2 weeks after I was termed to putting the deck together. So by March 1, I started going out to raise, and I had raised it by the end of July. So March, April, May, June, like 4 or 5 months.
Bill, I feel like, raising capital at those levels, I mean, just to me, I don't know about the people watching, it's an exceptional skill set. I mean, I really, you make it sound easy, and you actually take complex ideas and you make them very simple, which is why I think so many people, one of the factors why people follow you. But I see that as an unbelievable skill set. Raising capital, you make it sound like just like a walk in the park. It does sound kind of easy the way, but how difficult was it for you to get the capital commitment that you needed to start CV3 Financial? Is really what I was trying.
Well, here's the scariest part. The scariest part is, while I'm doing this, we're also having conversations with our group of what we're going to do. And imagine, like, if you're number one in the space, all our competitors were giving ridiculous offers to our top originators. Like, 2 of my boys are originators at the company, and they're pretty good sized producers. I saw like the signing bonus offers and the guaranteed comp. And so they're getting all this stuff, like numbers where you'd go, I got to consider this, right? And they didn't. So I felt an even greater amount of pressure to get the capital in on time, because what I was telling people was, we're going to stand this up by this time. Now, when I first communicated, I thought we would be able to stand it up mid-July, and I had to reset in June and say, for sure, end of August, we're going to do it. Now, these folks that were from Oldco, most of them got paid through May or June. So they got some pretty good severance, pretty good, like ridiculous.
Okay.
We did a good job there.
You did a good job. I know you were fighting that.
We did a good
front.
job.
You
we
were
did a
fighting
good job.
that front. I know you're proud of that.
I am. I'm proud of that.
Which is probably part of the reason why
maybe
people were so. There's so many different things.
But every day that went by that I didn't have firmed up capital, it was a day closer that somebody might have to go elsewhere. And so I did feel that sense of obligation and pressure to make it happen. And I needed to make sure that when I was out there talking to our capital partners, that didn't come through. Yet, I did make it very clear we could not start this thing with the A team unless I get this thing stood up by this time. So you should know, Blad, if you're going to invest X dollars,
it's got to be by this time.
We need to do this. So if that's not possible, better for you to tell me now so I could spend my time with those that can. And I ended up with some partners right now that were just fantastic. And the truth is, it wasn't just the equity that I raised. I had to stand up two $250 million warehouse lines with all off of our reputation from the back. Before those were from our two previous senior lenders, which were unbelievable partners, unbelievable. And we did it. Like, it was just kind of crazy.
Bill, was that stressful? Was it? What was your life like? Like, how were you holding it together? Was it a positive drive that was driving? Was it very stressful, uncertain time in your life when you were out there? I'm just trying to paint the picture of what that was like. The whole.
I wasn't stressed for me. I was stressed for the 155 that we're going to start.
That's the mark of a leader.
Yeah, I was okay. Like, I would be okay, and I'm going to be okay. But like, I was making representations to people's livelihoods, and you can't mess around with that. Like, that's a big no-no. You could fool yourself and mess around with yourself and trick yourself into things. You can't do that with somebody else's health and well-being. And I felt like that was my driver. I mean, I didn't sleep much for 6-7 months.
That's what I wanted to get at. Yeah. How stressful was it? I mean, you're leading these. I'm a Marine. It's no secret. I've served in the Marine Corps, and
thank you for your service.
I wasn't at best country to serve. Even though I wasn't, I didn't make a military career. Right, I served for 6 years, and I understood from great leaders that they were really concerned about when they were leading an entire group of soldiers into harm's way. It's really a leader that is really thinking about everybody else's lives and livelihood, like you're saying. So I wanted to know how that stress weighed into your life as you're making these promises and making these commitments and basically, putting the money together. It's not like it was already committed. That's difficult in itself, even when you have the commitments to make it work. But you were out there raising capital, Again, I want to give you credit for what you did in case you're so ahead that you didn't really dabbling into how difficult that seems to me. You were actually making commitments with people, negotiating their severance packages, and at the same time, putting the capital together for the next thing. And I think that is an extraordinary accomplishment. And I think I have figured out why it is that people are so loyal to you.
Yeah, thank you for that. Yeah,
yes.
It's nice to look back on. It's never nice during the time, but it's unbelievably satisfying looking back. And just sitting here thinking about it, there were, I remember my wife sitting in the living room, and we have a really big long island in the kitchen, and I would be walking around with my phone talking, like when we were negotiating the final terms of the capital. And you got to get it right. And you can't, the need and or desperation of raising capital to stand up a company in a period of time could not overcome the necessity of getting the right terms so that it had the ability to launch the company long term. And so part of that takes a tremendous amount of discipline, and you got to be ugly honest with the folks that are putting up the capital. And you also got to paint a picture, going back to what we said earlier. Like, I am creating something that we were going to buy for 9 figures. So our cash burn is what we paid for the company. And it's going to be a fraction of what it is. And so I believe that in my heart then. I believe it in my heart today. I know what the enterprise value of our business is, and it is significantly more than any of the capital that I raised. So that part feels good. But yeah, Blad, like there hasn't been a lot of people that have asked me that question. Like I don't even know if anyone's asked me.
I'm glad I got there.
Yeah,
I keep digging deep, and thanks for answering it as well. And I'm kind of letting you off the hook here as we wind down. Any chances of taking the company public that you can even talk about or anything? And you can dodge that question. We can delete it if you want to.
No, listen. I think
what's the future for CV3?
I have been approached by a handful of very, very, very large private equity firms that would like to do something with our company. The public market, there's not a lot of folks in our space. Velocity's one, but if you look at theirs, they have 2 products. They have the mixed juice and they have the DSCR product, and their entire model is just keep everything, build a balance sheet, and make the NIM. I know Chris Farrar there. He's done a very good job with that.
Yeah. I use them as well.
I have nothing but respect for the company.
I've heard you speak about them before.
But there's not a lot of firms out there for that. I think the key, if I were ever to do a deal with anybody, would have to have flexible and multiple channels of capital. And here's the reason why. When we were under Wedgwood, we originated and sold everything, which is great when there's nothing but buyers. When we were underneath PacWest, they never sold a loan. Their cost of capital.
PacWest, Pacific West, right?
Yeah, Pacific Western Bank. I call them PacWest. They never sold one loan. We had bids on some of our DSCR pools at 108. 108. 108. I never heard of it. And they wouldn't sell it because their cost of capital was 25 basis points. So everything for them was build the balance sheet. And ultimately, because of the reasons we shared earlier, that bank failed. So I always felt like you have to have the ability to hold loans. You have to have multiple outlets in multiple different sectors to sell, because insurance companies come in and out, REITs come in and out, hedge funds come in and out. Like, you have to have multiple different channels. And I think if you had a business that had maybe a variety of products, maybe you did equity lines or home equity lines of credits or the ground up, the RTL, DSCR. Do you throw in a non-QM? Probably not. I think you stay away from the owner-occupied stuff. But if you had multiple different channels, multiple different outlets, and the ability to balance sheet, that is nirvana. That is something that I would be part of. Having just this big company, and they're out there. And if you just think about other companies out there, like Anchor. Anchor's owned by Pretium. Genesis is owned by Rhythm. Lima is owned by MFA. Like, you go down the list, Renovo, mostly by Newberger. Like, all of them are already accounted for. So when new capital comes in, it makes it difficult for that new capital to penetrate into those companies, because their parent company bought them, created them, acquired them for those assets. So I think you would want a company to be partners with that was looking at enterprise value and best execution, and not just figuring out a way to have an ATM so they can get the assets. Because then I think it's just, at least from my seat, and it's not fair because there's other people have different perspectives, but then I think you're just selling. You're selling out to that strategy.
Selling is selling out sometimes.
So I think if you had that, if you had multiple channels and a cohesive strategy from the parent company to just best X the loans, then you're really servicing guys like you the best way possible.
Bill, where can people contact you? And I know you're everywhere. That this is kind of like the one that I want to really thank you for coming down here, for being there for the small guy like me, and coming here to Reading, Pennsylvania, and honoring us with your presence and your insight. You have so much knowledge to share with us. When can people get in touch with you?
With CV3 Financial, got a website. I think we have a whole bunch of originators on there. You work with Ernie Valadez, who's one of our best. and has joined us
I'm
today.
gonna bring Ernie on one of
Oh
these
yeah,
days.
so I
think he's ready.
If you're listening in, he's a good person to reach out to. I think is it Ernie.Valadez at CV3 Financial, ERNIE.VALADEZ at CV3
I'm gonna
Financial.
put a link for Ernie here as well.
That's great.
On the podcast. Thank you so much for coming out
was
here.
so fun.
Thank you for sharing so much
Thank
insight.
you for the McAllen.
I'm glad we could get that one right.
That was
for
good.
you guys. You've been watching Biz with Blad here. I've had the pleasure of interviewing the one and only Bill Tessar, the CEO and founder of CV3 Financial, a man with an indeed unconventional story, and I'm honored to having as a guest here today. Click on the links that I put here to connect with some of the resources that we're gonna give you. This has been another episode with Biz with Blad. This is Vladimir Mercedes signing off. Thank you.